day. Good morning, good afternoon, good evening, depending on where you're joining us from around the world. And welcome to the second panel of today's conference with the Institute for 21st Century Questions. This panel is going to be focusing on the global economy in the post-pandemic, post-US elections period. Exactly when the post-pandemic phase begins, I suppose, is up for some discussion. And I'm sure that will animate some of the comments from the rich panel that we have with us today. My name is Brett House. I'm Deputy Chief Economist at Scotiabank based in Toronto and a Senior Fellow at Massey College at the University of Toronto. We're joined today by Mark Wiseman, who is Chair of the Alberta Investment Management Corporation, the public asset management arm of the Alberta government. He's the former president and CEO of the Canada Pension Plan Investment Board and a former senior managing partner, director, I should say, at BlackRock. Secondly, John Kay, who is professor of economics at Oxford and a columnist with the Financial Times, joins us today from the UK. Vladimir Mau, Rector of the Russian Presidential Academy of National Economic and Public Administration, is also on this panel. And finally, we're joined by David Skilling, president of the Landfall Group. I'm going to turn to each of them individually to provide some initial thoughts of the big themes that they think will animate the economic landscape in this post-period, post-pandemic or post-first wave, perhaps, and post-US election, and then move into a series of questions and interactive discussions. Participants are welcome via the chat feature that they have opened to them to submit questions as well, which we'll be monitoring and put into the conversation as it progresses. So without any further ado, I'm going to turn first to Mark for his thoughts on what the post economic landscape looks like. Mark, over to you.
Well, thanks, Brett, and I'll keep my comments quite brief because I'm quite interested to get into the discussion. I do think that we have to think about two economies, and I think you've asked the right question. We have two economies. We have the COVID economy, which we're in right now. At least we are in the West, and the post-COVID economy. And during the COVID economy, it really is, by and large, a policy that is being driven by keeping that sort of economic heart beating. So, large amounts of not so much stimulus, but let's call it monies that are being spent just to allow people and to protect people and businesses during these extremely difficult times. And I'd argue that some jurisdictions have done this better than others. But the result of this spending is that we are racking up massive amounts of debt. And I think governments have to very quickly move to thinking about the very question you've asked today, which is, what is the post-COVID economy going to look like? And how do we stimulate sufficient growth to pay for the monies that we've spent during the COVID economy? And I would say, by and large, today, particularly on the fiscal side, very little has been done or thought about sufficiently in terms of stimulating growth, as opposed to protection, stimulating growth on the back end of this in order to increase what was sort of the pre-COVID run rate growth expectations to something that's going to have to be significantly higher to get us out of the very deep hole that has been dug in terms of the types of measures that had to have been taken over the past 9 months, and hopefully not for too much longer, but probably for at least another 9 months to a year. And I think government generally has been extremely slow. I can speak of the Canadian government, but I talk about that more broadly in the US and in Europe in terms of forward thinking about how we are going to essentially pay for all of this in a post-COVID world. And we'll get into it in some detail. And that then raises big questions. What are the limits of monetary policy going forward? We asked this during the global financial crisis, but I do believe that this time is quite a bit different. And what do we have to think about in terms of areas like inflation going forward, which I see as a very major risk in 2023 and beyond. So these are going to be, we're in a certain world today, and one hopes we'll be in a different world 6 to 9 months from now. But it's not like we're out of the woods by any stretch of the imagination. Well, we may be out of the woods from a epidemiological point of view. We're going to be in the thick of it, in my view, from an economic point of view. I mean, we will undoubtedly get into all of that in our discussion.
Well, thank you for setting the scene. I'm going to pivot now to Professor Kay in Oxford. Good to see you, and thank you for joining us today.
Hi, good to be with you. And let me talk a little from a UK perspective before we move into a more general discussion. As far as the UK is concerned, we have not had a good crisis. We are towards the top end of the world rankings in terms of deaths and serious illnesses from COVID per head of population. And we are also at the bottom end in terms of the impact on GDP of the measures that have been taken to try and contain the pandemic. We have also not done very well in political terms, that we began a lockdown in the spring with a very extensive goodwill and compliance, which has been dissipated pretty effectively over the last 6 months by weak political responses. And it is very striking how much poorer compliance has been with the lockdown, which was imposed in the last month, than it was with the lockdown in the spring. These observations about pandemic combine in a strange way with a group of observations about the UK economy, where of course the largest issue for the moment in the UK is Brexit. And the situation on Brexit, as many of you will know, many of you will be tired of this saga. But the situation at present is that there is a transition period during which it was assumed an agreement of some kind would be reached. That transition period runs out on December 31st. There is absolutely clear determination on both sides that this will not be extended, but as yet no deal has been agreed. And the issues on which the parties are apart do not seem much closer to resolution than they were in the past. Now, there is a widespread belief, which may well turn out to be justified, because this is the way the EU has always worked, that you reach a deal sometime close to midnight on the day of the deadline for actually reaching a deal. But I don't think one can be confident that will happen. I think, as I say, the way in which political preoccupations have been distracted by the COVID pandemic, both in the UK and in continental Europe, has made that much, much harder. And actually, even if there is a deal of some kind, it is now too late. It is too late in two senses. One is that there is going to be chaos round about Britain's ports and trading activity generally at the beginning of January. And the second is that we have not even really begun the process which will preoccupy so much of British politics for the next 5-10 years. Because the real difficulty, which has been very hard to get across to people, is that Brexit is not about broad hand-waving, sweeping issues. It is about immense amount of detail in relation to individual products and services and aspects of the unwinding of relationships between Britain and the rest of Europe, which have been built up in a particular framework over 40 years. So there is a huge amount of detail to be resolved, and very little progress has yet been made, even in asking these kind of questions, far less answering. So this is going to be a preoccupation, and I will not disguise my sentiments by saying it seems to me an unneeded preoccupation for people in Britain in business over the last decade. The other rather serious aspect, which again ties up with all of this, I'm talking about COVID, I'm talking about Brexit, and I'm going to talk about the future of the UK. And although all of these sound like separate issues, they are in fact all bound up together. The UK position revolves around two basic issues. One is Ireland and the other is Scotland. In Ireland, there is an issue which can be posed quite simply, that you either have a border between Northern Ireland and the Republic of Ireland, or you have a border between Ireland and the rest of the UK. And basically, you have one or the other. You can fudge that around a bit, so you have a bit of a border in some ways, in some places, and a bit of the border in other places and in other ways. And as most people on this call will know, there was supposedly an agreement reached on that at the end of 2019, an agreement in which, in effect, the Conservative government, which had been supported for the previous 2 years by the Ulster Unionists, that was what enabled them to be in government. The deal was that they sold the Ulster Unionists down the river by saying, well, if we have to choose, we have the border in the Irish Sea rather than the border across Ireland. In the last few months, the British government has partially reneged on that, reneging on the deal, and said we might not actually, in fact, we don't want to have a border in the Irish Sea. There is a bill going through Parliament at the moment, which contradicts the agreement with the EU, which was made at the end of 2019. And that has currently been rejected in the House of Lords. It will go back to House of Commons in early December, and we'll see what happens there. The obvious fact is that all of this is running out of time, and the US election has changed significantly the Irish situation, because the US now has a president who has rather strong Irish roots and an interest in the Irish border, which was not taken by his predecessor. So there's an Irish problem, which to my mind makes an end result of Irish unification far more likely than it has ever looked in my lifetime in the past. But that relates equally to the Scottish issue, which is that, as I imagine most of you will know, since 2007, Scotland has had a Scottish nationalist government. In 2014, there was a referendum, which by quite a small majority, 55-45, rejected the proposition of independence. But in 2016, while the UK voted leave in the Brexit referendum, Scotland voted quite strongly to remain. Consequence of that was that the SNP's position was strengthened, and the position today is twofold. One is there are Scottish elections next spring, which are likely to lead to a very strong vote for the SNP, and the polls are for the first time showing that if there were to be a referendum again, there would be a significant majority in favour of Scottish independence. And part of what has contributed to that is a sense that, which to be honest is more to do with appearance than substance, that Nicola Sturgeon and her Scottish government have managed the coronavirus pandemic a great deal better than Boris Johnson and the UK government. It has certainly greatly strengthened the Scottish government position relative to that of the UK. So it's hard to know how all this will end up, but we could be talking quite well within the next decade about the breakup of the United Kingdom that has existed for several centuries. Let me leave it there.
Well, thank you. I think that sets a number of big themes that we'll be discussing in our conversation with a very specific British and European context that is useful here. I'm going to pivot now to Vladimir Mau, the Rector of the President's Public Administration Economics function in Russia.
Well, good morning or good afternoon to those who are in the eastern part of the globe. First of all, I wanted to thank Ellen Student for organization of this event and to greet everybody who is here on the screen and maybe listening us. First of all, I wanted to stress, to remind that, you know, Kenneth Rogoff and Carmen Reinhardt, who is now the chief economist of the IMF, more than 10 years ago, wrote a book, This Time is Different. It was a description of 800 years of financial crisis, saying that each government, each time says that this crisis is different, but usually it's the same. But a few months ago, Carmen Reinhardt wrote a paper called This Time It Truly is Different. And this is very important to stress it because to my mind, it senses to compare the current situation with the economic crisis of the past, say with Great Depression of 1930s, of Great Recession, what is called events 10 years ago. Of course, it's interesting to use these comparisons, but it's very important to understand that this crisis is neither cyclical, nor structural, nor financial. Actually, it's not economic crisis per se. It's the key point in the analysis of this situation is that the source of crisis is external comparing to economy. We have the economic consequences of this natural challenge or disease challenge. And to my mind, the most reasonable comparison is with the war. There are many politicians who compare this pandemic crisis with war, but it's not just a good, bright word. It's important for understanding of the development of consequences of this event. And it's not only in Russia, it's in the most part of the world. It's important to compare with the war because we have existential crisis. This is the crisis of the basic problem is that we have the challenge from an enemy, and we do not know how it will behave. We do not know how this crisis will behave. We have army which withstand to it. We have intelligence service like researchers, scientists who try to grasp what would be behavior of this virus in the foreseeable future. But the whole situation is cannot be analyzed in economic terms. There are economic consequences, but it's not economic crisis. And the very choice between, say, Chinese or Korean or Swedish or British patterns of withstanding to crisis are substantially different. And the source of this anti-crisis policy is more related to political institutions, to level of confidence in our society, so level of confidence between public and governments. What a Swedish government would afford, say, British government failed to do, although at the beginning the attempts of British government was very similar to Scottish pattern. What can do Australia, which is far distant from the rest of the world, is different from what could do Italy, France, or Russia. So it's very much, this is a crisis which has very strong economic consequences, but at the starting point, we don't know what is right and what is wrong. I often compare this situation in the government with the discussion between Marquis Halifax and Churchill in spring of 1914, oh sorry, in spring of 1940, when Churchill became prime minister, when Halifax recommended to make peace with the Nazis, and Churchill responded that it was impossible. Well, in 1945, everybody knew that Churchill had been right, but the choice in 1940 was very unclear, and the arguments in support of Halifax were just strong, and this is what we have now. What is the choice between economic or infrastructure or human victims? What should we lock down the economy to help people, to continue economic activity with the risk to the people? But we know that lockdown of the economy is also dangerous in terms of life of many people. So it's very difficult and purely political choice. There is no economic rationality in this choice, and this is very, very important. Shifting to economic part, if I'm not too long, of the story, we should not forget that actually this crisis, if we would compare it with the crisis of the past, it's more the crisis of 1970s and not 1930s or 2000s. It's crisis of, basically, it started with the crisis of supply, not crisis of demand. And we should not forget the crisis of supply, when it is financially stimulated, it could end up with the stagflation. Stagflation is a very difficult problem. We, Western countries are mostly fighting with deflation now. They're very much concerned about very low and negative interest rates. But we should not forget the danger of stagflation. And when you stimulate the economy, when you press when you inflate money, put money into the economy where there is no supply, it's quite dangerous. It's quite dangerous, and we should not forget about these prospects. Although nowadays it looks quite strange. And one more problem, which is maybe important from the point of view of this military analogy, military comparison. We see that new institutions emerge just with us. New structural consequences of this situation. And it's again, it's very similar to what happened in World War I and partially World War II, when a new state-regulated economy emerged. And it was a debate to what extent it was just element of military economy or military politics, to what extent it will would last for in the foreseeable future. We know that the result of World War I was substantial change in basic macroeconomic ideas, points. Moreover, the attempt to reconstruct, to come back to previous economic system became very dangerous. The golden standard is maybe the most important element. Winston Churchill, as Secretary of the Treasury, as Chancellor, he wanted to come back to golden standard, and he did it. John Maynard Keynes insisted that it was the relic of barbarism. And let's not forget that reconstruction of gold standard in the 20s became one of the contributed a lot to Great Depression and hardships of the next decade. And this is a new institution which emerged now. Of course, it's not about a gold standard, it's about online, it's about a new mechanism of regulation, it's a prospect of a new role of the state, it's a prospect of big brother. Maybe George Orwell was correct, but he was wrong in the date, but not in the date. He was wrong speaking about Big Brother in 1984, but it can come late, and this is also one of the consequences of this natural crisis, I would say. Thank you.
Thank you very much for those very interesting remarks. I'm going to wind up our initial tour de table with David Skilling from the Landfall Group. Over to you.
Great, thanks, Brett, and thanks for the opportunity to be here. What I thought I might do is just offer some short-term remarks and then some structural observations. I'm now sitting in Europe, but up until recently was living in Singapore. And I think the contrast between Asia, as is to Mark's point, the difference between Asia and Europe, and certainly the US, is quite marked. Many of the Asian countries, from Singapore to New Zealand to Taiwan, have done very, very well in controlling the spread of COVID, and are now experiencing reasonably strong economic recoveries. Taiwan put out better numbers today. So in a sense, although not back to normal, things are certainly tracking reasonably well in Asia. And it's interesting also to look at the world trade data, which has held up actually pretty well. Again, Asia being an important driver of that. Moving to Europe, of course, things are not quite so rosy, but again, the infection numbers are coming down quite sharply on the back of quite stringent lockdowns, which will be in place still for some time, but things are certainly moving in the right direction. And I think it's also encouraging that the lockdowns, the second time round, if you like, better calibrated. There's less economic damage, there's more workarounds, people are figuring out how they can sort of maintain a sense of normality even while working from home, or while bits of the economy are constrained. So if you like, the extent of the economic cost in the second wave is not going to be as it was earlier in the year. The US, of course, is a slightly different kettle of fish again, where the numbers are still spiking up. And hopefully this weekend won't be as bad as we're fearing, but the US has clearly got a way to go. Hopefully with a new administration coming in, there'll be a sort of more coherent approach to the deployment of vaccines, the control of COVID and the like. But I think the US has got a bit further to go before it turns the corner. But although it's going to be, I think, a jagged and gradual process with a degree of geographic variation, we're clearly moving in the right direction. I think that's positive, off admittedly a very low base. Q2 was awful. So if you like, the only way was up, but we are, I think, tracking in the right direction. But that doesn't get us to where we need to get. And I think, again, to Mark's point, the reach, the severity and the duration of the COVID shock will mean that it has quite profound structural implications for the behaviour and performance of the global economy going forward. And so, although I think for the most part, many advanced economy governments have done actually pretty well in terms of the macro policy response, discretionary fiscal stimulus, monetary easing, and I think that's been to the good and will accelerate the recovery. There are a bunch of supply side, more structural dimensions that I think governments will need to grapple with if they want to sustain a stronger recovery. It's all well and good to talk about building back better or building back stronger, but that's going to involve, I think, much more than simply macro policy tools. So just to give you a flavour of what I think some of the key dimensions are of the structural dynamics. Most obviously, I guess there are some sectoral dynamics at play. Hospitality, international tourism, physical retail have all taken a significant dive in the short term. But I don't think they are going to recover to the levels at which they were pre-crisis. People have discovered substitutes. We're having this conference online. People are now conducting business online. So business travel and parts of international tourism won't come back. And obviously many of the firms in those sectors won't be able to ramp up capacity. So there's going to be, if you like, sectors that have got a negative structural outlook. But on the plus side, technology has taken a big kind of leg up. The transition to digital economy has been compressed. Perhaps bits of healthcare similarly. So there are some sectors that are structurally challenged, I think, some sectors that have much stronger growth prospects. And I think the challenge there for government is, if you do have this sectoral reallocation underway, how do you support the labour market? How do you support people to reskill, to move into different occupations in as quick and as seamless a manner as possible? So that speaks, I think, to a major education, skills, retraining agenda, making sure your labour market policy is supportive of that. It's akin, I think, to the deindustrialisation process 30 or so years ago, where you had significant transfers of labour across the economy. And yes, it's important to have a high pressure economy supported by fiscal policy and the like, but if you're not also operating on the supply side, make sure that people have the skills to move into these sectors with stronger growth prospects, you are going to run, I think, into significant problems. So that's dimension one. I think the other dimension, perhaps a little bit related, is there is going to be a difference, I think, in the nature of activity. We are seeing, I think, sort of a significant blow to labour-intensive occupations and more support for knowledge and capital-intensive occupations. It's partly a reluctance to engage in physical contact, human contact. You are keeping our distance more and more. It speaks also to the growing importance of the digital economy, the ability to undertake activity in a virtual way. But I think it's going to accelerate the process of firms investing in technology, investing in automation, and moving away from labor-intensive occupations. Now, again, clearly that has implications for employment, for labor markets, but also for the business models that are undertaken, and the kind of things that countries and firms need to do to maintain competitive advantage. And again, this speaks to much more than simply macro. It speaks to an agenda, yes, around skills, but also research and development around universities, around innovation policy more broadly. And then lastly, I think the functioning of the global economy is going to continue to change. Clearly, this is not purely a COVID phenomenon. We've had trade wars, protectionism, supply chains being localized pre-COVID. The effect of COVID will be to accelerate, I think, those dimensions. And again, for countries and firms, figuring out how you position yourself for that new world is going to be a significant challenge, even with a Biden administration removing the psychodrama from the global economy. But I'd like to close just very quickly with a kind of a more, if you like, optimistic take. I'm not normally glass half full, but I will be for the purposes of this conversation. You know, there are some major challenges, to be sure, of a type that I've just described. There is a major structural transformation that is required. But I put out a note last week where I speculated about a post-COVID productivity renaissance. That the intuition, and this is not a forecast as much as a plausible scenario, I think, and one that I'm increasingly inclined to take seriously. There has been across most of the advanced economies, you know, a secular productivity growth decline over the last several decades or so, with a slight blip during the 90s with the kind of IT revolution. But it's been pretty much one-way traffic. But if you think about some of these dynamics around digital, around the energy transition to clean, around the transition to more capital and knowledge-intensive modes of production, and all of that happening on an accelerated time frame, you can begin to tell a story about, you know, a much improved outlook for labour productivity growth over the next sort of several years and beyond. That might be sufficient to kind of jolt the advanced economies off a fairly kind of low productivity growth trajectory into something that's a bit more positive. Again, it's not just investing in physical capital or technology. It needs to be accompanied by human capital, new business models, all those intangibles as well. But I think, again, the question is whether the severity and reach of the shock, which is unprecedented even compared to the global financial crisis a decade ago, is sufficient to usher in a period of stronger productivity growth than we might otherwise have had. So I guess the question is whether there is a silver lining to the COVID cloud. So look, let me stop there and interested to take part in the Q&A.
Well, David, I think you set the tone for the discussion very nicely by making the distinction that you did between short-term demand maintenance measures, or as Mark characterized them, bridging financing for households and businesses, and the measures that fiscal policymakers need to consider to help manage and advance that structural transformation that is beginning, accelerating, and could characterize the post-pandemic economy that we're looking at. I'm going to build on that and pose the question to our other panelists. Are we sufficiently through the pandemic economy to pivot to thinking about those structural measures? And as we ask policymakers to walk and chew gum at the same time, what do each of you see as the priorities for both demand maintenance in order to bridge us through the crisis and structural supply transformation for fiscal policymakers? I'm going to turn first to Professor Kay, then to Vladimir Mau, and lastly to Mark Wiseman.
I think in a discussion like this, we always need to have in our minds what is very often said, which is people overestimate the significance of short-term trends and underestimate the significance of long-term ones. So that I think we've experienced an extraordinary shock to the global economy. This will go on resonating for a few months more, but actually there are not many fundamentals about the global economy which it changes. Nevertheless, there are underlying tendencies in the global economy which will over a period be reinforced as a result of this. To take the banal example, I can't count the number of people who've said over the course of the last 6 months that the office is dead or something of that kind, that central London and Manhattan will be deserts from now on. And that's a good example of the overestimating the short-term trend and underestimating the long run. I think I know a lot of people who can't wait to resume both social and business contact and get back to working something like normal in an office. And I've little doubt that what has happened over the last few months has been possible only really because of the personal connections which had been developed in the past. It's one thing to work remotely with people you've been used to working with for years. It's quite another to make connections only remotely. But nevertheless, people have learned that it's possible to work from home. We've grasped and developed the technologies like Zoom that enable us to do things remotely that we, even if we were able to do, didn't do historically. And that will have long-run impacts on the way we behave. So let's always have in our mind that we're overestimating the significance of immediate events and put in our minds what is actually happening to the long-run trends. I think that's near to where we need to be. Now, we've talked a little so far about, as it were, the macroeconomic significance of all of this. And this is both complicated and I think unprecedented. It's complicated because what we've had is both a demand and a supply shock. Restaurants have been shut, but correspondingly, we haven't been able to go to restaurants. And the money I might have spent on restaurants is mostly still in my bank account. And I suspect that is true of most of the people on this call as well. Very strange things have happened to output, to inflation, to savings and the like in the course of this. A lot of that will probably be unwound in the year or two post-COVID that we're now looking forward to. But a lot of it will not. People have talked also, and it's important, about the government. There's less government action to demand stimulus. It's not so much stimulus as action to prevent individual households and businesses from collapsing in the course of this pandemic. And that has cost a lot of money and it has to be paid for. But it has to be paid for in the very peculiar circumstances from which we began, which was a completely unprecedented level of short-term interest rates. I mean, normally, well, short and long-term interest rates, which is perhaps even more important, because governments have run up huge debts, most notably in wars in the past, and been crippled by debt service burdens and inflated in order to eliminate them. That's actually not what's happening here, because governments can finance this debt at such low interest rates that the actual burden of debt service is not going to be very large for the foreseeable future. It's not in that sense going to constrain other forms of public expenditure. But then we need to ask the question, well, where is this where is this debt going? To which the answer is basically it's going into pension funds and long-term investment funds. And that means what we are really doing is passing the burden of paying for this over to ourselves as pensioners, or indeed our children and grandchildren as pensioners, rather than paying it now up front. In this sense, the debt we've incurred this time round is really rather different from the debt that was incurred by major Western economies as examples in the Second World War or in the crisis of the 1970s.
Thank you. And I think you highlight a very important issue in terms of the profound difference in debt that we're looking at now, whether it's in developed or emerging markets. We're seeing, a decline of original sin where emerging markets are no longer as concerned about currency depreciations and have been able to stimulate their domestic demand, both on the fiscal and monetary sides. And we saw Peru on Monday issue a century bond at a historically long tenor for the country, despite coming through 2 weeks of incredible political turmoil. So your point about the debt being much longer term than it's been in the past is also very well taken and reflected by events even just this week. Vladimir, I'd like to pass the baton to you.
All right. I wanted to start with the point of Professor Kay regarding long-term and short-term perspective. But the problem is that we could see the conflict between long-term and short-term measures. We live in the world where everything which is good for the short term, for the nearest month or year, is quite bad for 10 years perspective. And everything, almost everything, which could be very positive in 10 years perspective could not be reported in the nearest election, in the nearest political cycle. And this is a real political threat. Moreover, most of politicians and many economists believe in a loose financial policy, fight against austerity, which is quite understandable. But we should not forget that weak financial, monetary, fiscal policy can soften the pain, can soften the hardship, but cannot mend the problem, it cannot heal the structural economic challenges. This crisis is not structural. This crisis is not cyclical. But let's not forget that it exists not just in the cosmic realm. This crisis came after the global structural crisis of 2008, and that was a very interesting crisis. The situation was improved quite quickly without improvement, without solving any structural problems. Let's not forget that one of the lessons of last 10 or 15 years is that we learned, we are very experienced now in anti-crisis policy. But the result is that there is no positive destruction anymore. We do not clean the economic realm. We do not we prefer fighting short-term economic problems without deep, serious structural transformation. And the structural problems which appeared, which became clear 10 plus years ago, didn't disappear. Many problems of structural problems just increased. Particularly, we live in a very strange and very unhealthy macroeconomics with a huge and growing debts. Of course, there are some strong believers in modern monetary theory that the debt could be increased endlessly by those who borrow in local currency, but we understand that it cannot work. There is no perpetuum mobile in the economy as well as in physics. You cannot print money endlessly and be happy. Of course, global currency, of course, there are some arguments. There are some arguments why inflation now is low. But what economic history teaches us, that crisis happens later than you predict, but earlier than you expect. And it is also a very important point which we have to remember. There is no structural or solvency crisis at the moment, but it doesn't mean that it will not happen. It does mean that it will not happen. And long-term consequences in current non-traditional macroeconomic policy, to my mind, is very dangerous. We forgot well, previous 40 years from 1980s to 2008, everybody in the West and in Europe were concerned about inflation or stagflation. Never forget about this, as if it would never happen. To my mind, my experienced economic historian says that usually in the economic problems with comes at the moment when everybody believes that it will never happen anymore. Oil prices go down when everybody believes that it will never go down. The same is with the macroeconomic consequences of current economic policy.
Thank you. And for a last comment on this, Mark, I'd like to pivot to you. You highlighted in your opening remarks a concern about slowness in economic and policy thinking from Canadian governments. Could you expand on that, both in the Canadian context and in the international context that you're looking at from your seat?
Well, thank you. And I want to pick up on a few points, the threads of my panelists, because I think we're all pointing in the same direction, and in many respects, David's comment about the optimism of the glass being half full and the hope of continued productivity gains. Well, boy, he all I can say is he'd better be right. I hope he's right, but I'm afraid, very afraid, if he is not correct, because yes, in many respects, this time is different, and this idea that government can sort of magically continue to service this debt, and that we're going to benefit from this low rate environment sort of perpetually, I think is a wonderful thought if it's true. But the consequences, if it's not true, and I think this is what Vladimir was saying, will be extremely, extremely deleterious. And let me just put this in perspective. And it's not to say that we shouldn't be doing even more than we have, including in Canada, by the way, in terms of supporting both households and businesses during this COVID economy. But that inflationary pressure will come sooner or later, unless David is incredibly right that we can find significant productivity gains to push us in the other direction. And I guess I'm much less confident than he is that will take place, particularly without government money shifting from being spent from support to being spent for growth. And the downside of this is very, very troubling, because I think Professor Kay is entirely right. The burden of what we're again having to do today to support today's household and businesses is undoubtedly going to get pushed, not just to us in retirement, and I'm going to come to that in a second, but also to our children and grandchildren. And we're already seeing inflation, massive inflation in asset pricing. And that's one of the things that does make this time quite a bit different. Those that have wealth today are much wealthier than they were a year ago. Those that own assets, be they financial or real assets, are much wealthier than they were a year ago. And yet those that don't are finding themselves in a more and more difficult situation. And it's hard for me to imagine that we aren't going to see that inflationary pressure come, not just in terms of asset pricing, but ultimately that working its way through into the real economy. And that's going to work its way through into the real economy, just because of the volume of capital that has been injected into the system. And secondly, because we are going to have real changes in terms of the way that we've operated. I believe that the need both from government and business to build more resiliency into supply chains becoming less efficient, as a result, driving higher costs into the system. And I think that lag in terms of bringing supply back online, particularly in the West, is going to be extraordinarily difficult. And so I do believe that we have again, not without good reason, but have put ourselves in this crisis into a situation that is going to be extremely precarious. And if we don't have, a stimulative effect to be able to sort of outgrow that debt, that is going to be extremely problematic. From an asset manager's point of view, from an investor's point of view, and I just want to pick up briefly on this comment about pensions, because I think this then creates a very sort of thorny problem as it relates to those future commitments as well. Because keep in mind, whilst we've had this nice run in the last year, and in truth, probably for the last decade in asset prices, persistently low interest rates have also massively ballooned liabilities. And so, in fact, in most parts of the world, Canada is actually thankfully an exception, but in most parts of the world, you actually see those future commitments in terms of protecting people in retirement being massively underfunded, and that underfunding gap increasing because, of course, when you discount those future commitments at the current rate, you end up with with a very large, much larger than has been the case historically, in terms of the net present value of those liabilities. So I think we have a very thorny problem on our hands, and I think that this view of government, and we've heard it in Canada from the finance minister, which sort of made me scream at the radio when she was speaking, that we're somehow, because this time is different, we're somehow in this position that we can afford this massive debt burden. And my view is, yes, this time is different, but the laws of physics, economic physics, don't change. And so I am exceedingly concerned with the lack of focus on the post-COVID economy, and both in Europe and in North America, this kind of unending reliance by policymakers on monetary policy as opposed to fiscal policy. This cannot go on.
Well, I think our conversation has really highlighted, I think, one of the key tensions in the discussion about what the post-pandemic economy is going to look like. Vladimir and Mark, you've both pointed to the possibility of substantial inflation ahead, as has former Bank of Canada Governor David Dodge, really based on more or less a kind of monetary aggregates argument that when monetary supply balloons as much as it has, we're inevitably going to see big price increases in the future. Mark, you pointed to 2023. Others, such as Larry Summers, have argued that inflation is likely to be low and remain low because of the massive savings glut that we have in the global economy. I'd like to go around the table again and really zone in on this question. How do you see inflation evolving over the next few years, and what should policymakers do in response to it? I'm going to start with Dave, move over to Professor Kay, and then back to Vladimir and Mark again. And I'd ask you to be brief this time around. We have about 14 minutes left, and I'd like to get some closing comments in from both of you after this round of discussion.
Sure. So look, on inflation, it's very difficult to say anything categorical. As Mark was saying, it's not hard to conjure up a bunch of supply side constraints coupled with enormous demand side stimulus that leads to inflation pressures building up. The monetary aggregates across most of the advanced economies are eye-watering. I mean, they're much, much greater than they were during the global financial crisis. So a lot of it depends, I think, on two things. One is the pace of the economic recovery, how rapid that is. How right is Larry Summers that it's going to be a long time in coming versus, are we actually able to claw our way out of that? And secondly, what happens on the supply side? So the extent to which we actually do see productivity improvements emerging. So the case that I was making was more out of hope than expectation in particular. I think you can make a case for it. I'm not sure it's a prediction, but I think we haven't seen inflation, at least not in terms of CPI, emerging despite a decade or more of enormous stimulus on multiple sides. Perhaps we're now running into those constraints. So, to be honest, I wouldn't be surprised with Mark's base case that we do see something bubbling up. But equally, as an economist with two hands, it may be some time off. But I think from implications for policymaker perspective, we do need to spend much more time, yes, getting through the next 12 or 18 months, but getting the supply side right. And that includes a generous definition of supply side. How do we get labour markets working? How do we make sure that labour supply and labour demand are aligned? How do we actually do the structural things to get the economies more efficient and in an inclusive way that frankly we didn't do during the GFC? That was entirely a demand side story. I think this time, partly for political and social reasons as much as anything, we need to get the supply side story right. If we get that right, then I become a bit more sanguine about the inflationary outlook.
Thank you. Professor Kay.
Inflation has been under control now, basically, for 40 years, and indeed for most of human history. And everyone seems to believe it can't last. And for at least the last 20 years, people have been predicting accelerations of inflation, which have not happened. What happens to inflation in the very short term may be quite random as the economy recovers in some ways that are quite hard to spell out from this COVID shock. What happens in the long run? I'm with David on the optimism side in terms of productivity, in part because I think the largest trend, a relevant trend in the global economy, is the ways in which the IT revolution, which we've seen in the last 40 years, mainly within directly affected information technology related activities, is gradually spreading into things that don't seem at all obviously about information technology. You have obvious examples of that in terms of, immediate examples of that, in terms of autonomous vehicles and big data-based healthcare. And there are going to be a lot of things like that, many of which we haven't dreamt of yet. And that also goes into a question about the productivity statistics, because all our thoughts about measuring productivity come from a world in which typical firm was General Motors, and you could count the number of cars that came off the line every day. The world isn't like that, and it's been less and less like that for the last 20, 30 years. One might stop and think for a moment about this conference. It might have been held in the conventional way, and we're now holding it via Zoom. Ask yourself how that difference shows up in the GDP statistics, in the inflation statistics, and also think about how you would like it to show up in these statistics. And I think you will talk yourself into considerable confusion really quite quickly. I debated this with a group of economists just a week or two ago, and confusion was certainly the result there. We're not measuring these things very well anymore.
I think that makes a very important point. Vladimir, what would your view be on, given your concern about stagflation, how policymakers should be reacting and anticipating to that fear?
Sorry, I have to respond. I have a call from the government. Of course, it's quite difficult, but first of all, we have to be careful analyzing economic data, again, following what my predecessors have said. For instance, to my mind, GDP is not important indicator currently. We know, again, from the history of last 40 years that GDP could accelerate, but economy go to crisis. GDP could stagnate, as it was in the Soviet Union, for instance. It was acceleration with the emerging crisis. Or GDP could stagnate, but quality of life is improving, like in Japan, in the last more than quarter of the century. So GDP in a situation of current technological transformation is quite unclear indicator. You know, many years ago, I think it was Paul Samuelson who wrote that a man who marries a maid is decreasing GDP because stops buying a lot of services. And this is a very similar situation. Most of the services, new services are getting cheaper, and formally GDP is decreasing. Moreover, in this pandemic situation, a sharp decrease of GDP also means nothing. It could contract and then increase. Unemployment is more important question, unemployment and well-being. Maybe I would say very well, politically incorrect thing, but I would be more cautious about inequality, because there are two different things when you have increasing inequality with the growing prosperity of everybody, or increasing inequality when prosperity of the low part of the society is stagnating. There are two completely different things. And what is important is not, to my mind, inequality per se, but how inequality is connected with the improvement of general well-being. And we should say honestly that there are two different things. To have decrease in inequality with the total global total stagnation is much worse than increasing the inequality when everybody is getting better. So there are some important things which are not which are not going from wishful thinking. And maybe the last point I wanted to stress, well, economists like generals, they're trying to get prepared to the previous wars. We have to understand that the war is different. And even if 800 years of financial crisis reminded each other to some extent, but if we could predict crisis, it would have never happened. The crisis happens because each time it is a new crisis. And we have to analyze the current challenges and not trust too much in the previous ones. As economic historian, I like historical analogies, but it doesn't work. It could explain something, but it could not give the clear recommendation of what is to be done. And thank you very much.
Mark, I'm going to reframe the question just ever so slightly for your role as an asset manager. Given your fear about inflation, do you see solvency problems dominating major debtors in the years ahead as interest rates get pushed back up in response to those inflationary pressures? Or do you see debt burdens being inflated away and remaining stable and sustainable in the near future?
Well, I think it depends. I think it depends whether you're talking about government or you're talking about enterprises. I think I'm less concerned on ultimately on the enterprise side. And I also, because at the end of the day, debt burdens since the global financial crisis in enterprises continue to be quite low compared to where they are. So we have learned something from the past crisis. This one is different, but we've learned some things. Our banking system is in incredibly good shape. There is we've had no issues with liquidity, even in the early innings of the COVID crisis. So I'm not really, the structure of markets have held up well, and I think the structure of enterprises have held up well. It's just, to me, it's more of a question of what is the policy, how do you think about the policy response? And here, I think, whether you're an optimist like David and John, which I typically am, by the way, or if you're maybe slightly more worried, it seems like Vladimir and I are, the policy response, I don't think is much different. It has to be, at the end of the day, government investing in from a fiscal perspective, in productivity, long-term productivity growth undertakings. I think you have to see investment in long-term infrastructure. For example, you have to see government stimulating which we've not doing enough of in this country, and I don't think elsewhere, stimulating that innovation side of the economy. It means ensuring that you have tax regimes that encourage the type of invention, innovation, and productivity enhancing businesses and new ventures that are going to be required to get to the outcome that David and John I think are pointing out. So I actually don't think whether you're a more optimistic or more pessimistic. My view is that the policy response is similar. It has to be a move from monetary to fiscal, and the type of fiscal has to be in terms of stimulating private sector productivity enhancement.
Okay, thank you. We are coming up close to the end of our time, and so I'm going to turn to each of you for really a 2 or 3 sentence set of predictions for the next few years. What do you think is the biggest animating theme for the global economy that we should be paying attention to, over and above the issues we've discussed during this roundtable? David, I'll go to you first.
No, I think to me, I mean, there's a bunch of economic issues I could talk about, but the key thing to me is state capacity, the ability of governments to make high quality policy choices. And we've seen that over the last several months, variation in response to COVID, both on the public health dimension and economically, has a lot to do with how good governments are intrinsically. And I think going forward, variation in the speed of recovery, both in the short term and the structural outlook, will depend on the quality of policy making, the extent of state capacity. So when I want to form a view on how optimistic or pessimistic I am about various countries, that's a thing that I would zero in on. Governments need to be investing in policy making capacity if they want to make more progress on this crisis than they have on previous crises.
Okay, an emphasis on public policy making and capacity. Professor Kay, I'll turn to you next.
Long-term economic projections are mostly about what happens to technology, and policy responses can delay that, accelerate it, mess it up for a bit, but it's the underlying productive capacity of the economy and indeed of human intelligence that governs any long-term projection. And if a last word would be to say that a phrase that has come up quite often in this hour is "this time is different." And it's really important to know when that is true, as in all major economic crises have aspects that significantly differ from all previous ones. And when it's not true, like there are accounting identities which remain true and valid in every situation and every crisis, and we need to the discrimination to tell one situation from the other.
Thank you. I think you make a fantastic point there, particularly because many discussions do get muddled on that last accounting identity issue and try to do contradictory things at the same time. Mark, a last word from you, and then I'll go to Vladimir.
Very quickly, 2 things that we haven't discussed in a great amount of detail, but I think in the long run are what is going to define us economically and perhaps beyond. One is this growing wealth disparity that we did touch on, and I think this crisis has accelerated that wealth disparity and understanding the impacts both economically and geopolitically that's going to have. And then secondly, the trans-Pacific competition and the implications of which we didn't talk about at all between China and the US, or China and the West, frankly. I think those two issues ultimately, when we get through this crisis, are what's going to dominate the next several decades.
Vladimir, a last word from you.
Thank you. I would maybe also mention 3 points in the short run, in nearest run. It's, again, I would agree, efficiency of government policy, but with my point is more precise. The real danger of populism. We did mention it, but populism from the left and populism, we know left budget populism, typical for the second half of the 20th century. Now we see a right-wing populism. So the real inefficiency of policy based on populism. This is the most important short-term challenge for our society. Longer-term problem is the institutions of human capital. Current trend, technological trends, digitalization, they would substantially transform healthcare system, education, and pension system. I would point out these 3 points. And it's very important to grasp and to elaborate the institutional prospects of this area, the areas of human capital. This becomes the main source of economic development, and this is very important. And the last point is the prospects of globalization. Deglobalization is not a trend. The real trend, the globalization will take new forms. Maybe it will be regional globalization, but it's very important to avoid any obstacles, populist obstacles on the way of globalization. There are 2 main sources of economic, social and political efficiency, globalization and human capital. And it's very important to remove any obstacles from the development of these 2 areas.
Excuse me, your final points really highlight the diverse range of ways in which this conversation could continue. I wish we had more time to do so, because in some ways, your themes for the future highlight a kind of economic desiderata, a real need to distinguish which things are long-term, which things are short-term, which things we can control, which things we can't, and which things are the same as before and which things are truly different. So I wish each of us the wisdom to make those distinctions, and I look forward to seeing how some of your predictions and hypotheses about the future play out. Thank you to each of you for being with us today. Thank you to the participants for your questions, and I join the organizers in looking forward to the rest of the conference today. Thank you very much indeed.